President Donald Trump has announced a 90-day pause on his reciprocal tariff just 24 after it came into effect. Now, Trump's latest move was seemingly to attempt to narrow down what was building up into the unprecedented trade war between the US and most of the world. Global markets, of course, reacted positively to the news. However, he announced an immediate increase in tariffs in China to 125%, up from the previously declared 104%. Now we are joined by Dr. Amitendu Patil, a senior research fellow and research lead at Institute of South Asian Studies, and Seth R. Freeman, who's a senior manager director, Glass Rantha advisor and Capital Group, to talk about the same. Hi, good morning to both of you. Thank you so much for joining in. Well, Mr. Palit, let me come to you first. This whole tariff saga that's been playing out, yesterday this announcement of a pause came in, and on the back of that, the entire global market jumped up in glee. But really, are we out of the woods yet?
Thank you for inviting me to your show. I think the point that I'd like to make here is that, look, this in a sense reflects the uncertainties and hesitation that are building up within the Trump policy establishment about the policy that it is following. This is not the first time that he has put a pause on tariffs. If you go back earlier and look at the way tariffs were handled with respect to China, Canada, and Mexico, particularly Canada and Mexico, he did pause. And there were periods over which there was back and forth. But on this occasion, let us not forget the fact that the reciprocal tariffs were announced only on the 2nd of April. The baseline tariff went into effect on the 5th of April. From the 9th of April, the higher amount was supposed to take effect. But immediately thereafter, within 48 hours practically, there is a pause. I think this is now beginning to make the whole story very clear as far as the Trump tariff rule is concerned, that the impact of that is clearly something which the administration had not bargained for. And the question that I'd like to raise at this point is, the United States brought in these tariffs on the ground of a national emergency. That is what the executive order said, that the trade deficits are very high, so tariffs are needed to correct those. As a result of that, the reciprocal tariffs are needed to be brought in for correcting countervailing tariffs on the other side, as well as other non-tariff market access barriers. Now, obviously, that situation has not changed, but then why the pause on behalf of the United States? The question ostensibly is because there is this realization that if this is maintained, the damage for the United States in the short term economically is going to be much, much more than the countries on which it is imposing the tariffs. The tariffs are being brought in on the assumption that even if goods coming into the United States become more expensive than before, the government will obtain tariff revenues. That will be a fiscal boost for them. And down the line, there will be federal income tax rate cuts. So as a result of that, consumers will also be better off. And subsequently, we will have companies working in other parts of the world going back to the United States and making for the United States market. But this is not rocket science under any circumstances. If this has to play out in the way it has been planned, forget about the theoretical soundness of this whole idea. The kind of hits that markets, investments, technology movements, people movements, and everything are going to take place around the world is going to be enormous. And let us not forget the fact that the United States at the end of the day accounts for roughly about 12 to 12.5% of the global trade. There is a huge world of trade outside where United States doesn't figure. And that world is actually showing the tendency of coming together. There has been retaliation by China. There has been retaliation by EU. Canada has retaliated. There are countries who are beginning to think this through, pausing the exports, holding on to shipments. And the Trump argument that there are countries which are reaching out to the United States for correcting their trade deficit applies only to 2 or 3 countries till now, maybe Vietnam, maybe a couple of other countries. So it's actually not turning out to be as it was expected to pan out.
Right. Let me get on board Mr. Freeman also. Thank you so much. Good morning to you, sir. Thank you so much for joining us today. Besides the wild moves in tariff, another asset class that is giving really wild moves is the bonds, and that's something we need to watch out for. In fact, even Trump alluded to the moves coming in on the bonds. Now, there are a number of theories to explain the move in the bonds, ranging from forced selling by hedge funds, getting margin calls, to more troubling speculation of foreign holders dumping U.S. government securities. Now, the largest holders of treasuries are Japan, China, and UK, the very countries like the U.S. has targeted with some of the highest tariffs. Now, if China starts selling the US treasuries, what is going to be the bond market scenario, and how is that likely to shape up? Is this market going to be dominated by the bonds now?
Well, I think what the action and the reaction in terms of the pause in the tariffs was a response to bond rates rising abruptly. And the president and his advisors were seeing their strategy completely blow up. They were looking at not only higher prices for U.S. consumers, but higher borrowing costs at the same time. And, the whole thing fundamentally doesn't make any sense, but this would have been even worse. We saw, what happened the day before yesterday, and then we had this relief virtually immediately after the 90-day pause announcement. We had two things happen within the same day in terms of volume. We had the highest volume on the sell side and the highest volume in history on the buy side once the 90-day announcement was made. It's not sustainable. The president's advisors are rewriting history and saying, gee, the whole strategy was to cause the initiation of trade discussions with various foreign leaders, and that the president needed to do something very drastic to have them reach out to him, which is completely ridiculous and not how diplomacy and not how trade negotiations customarily work.
Right, Mr. Parekh, let me get you also on board for coming to you then. How do you see the bond market shaping up, and is there going to be a bond market challenge now going ahead?
I think that challenge is already surfacing because the issue that is facing fund managers and, broadly speaking, the long-term asset class of investors across the world is the uncertainty over the credibility of United States long-term debt. And this credibility is arising from the fact that if the United States fiscal situation worsens, which it is likely to following the kind of developments that one is seeing, because there will be a fiscal contraction following the fact that there is a very strong possibility of economic growth going down and the ability of the government to collect revenues, because tariffs, the projection that have been made for those of around $600 billion coming in just through tariff revenues is based on the fact that the amount of exports to the United States remains the same as it is at this point in time, which is very unlikely because there is going to be diversion. There is going to be, de-risking coming back in a different way. So that revenue is going to go down. If on top of that, there are expansionary fiscal policies in terms of federal income tax rate cuts, that is clearly going to impact the fiscal health of the US economy and, in turn, its ability to service long-term debt. So I think there is that concern, which is gradually shaping up in a lot of investors. But the problem, Ankita, is also that, look, where do you identify choices and alternatives now? Because we have just seen that China is looking to support those industries which are getting damaged. The Chinese economic growth now is also lower compared with baseline to baseline, compared with what it was earlier. The fiscal stimulus capacity of China might not be as large as it was during the time of the COVID-19 breakout. So I think there is a serious concern insofar as the global investment community is concerned, as far as the long-term debt prospects and the yields for them are concerned. So we are going to see all kinds of possibilities emerging, including, backing heavy on gold, coming down from the American dollar, drawing down of foreign exchange reserves. It's all a chaos, if one can define it that way.
Right, Mr. Palit, I'll come to you again on that of the macros that are playing out and what does it mean for Indian markets. But first up, Mr. Freeman, let me come to you now. Now that there is a pause, a 90-day pause on tariffs on countries barring China. Going ahead, how do you see this panning out? Because US will have bilateral talks with India as well. Do you see the rates, the final rates rather, to temper down eventually?
I imagine that they will. The underlying calculations that were made, that the tariffs were based on, was flawed in the first place, and this should give some opportunity for certain countries to straighten this out. But the 90-day pause is interesting, but it doesn't provide the level of certainty that businesses need to do planning. It's very risky to make significant investment decisions, capital spending decisions in this kind of environment. And we also have to think about something very practical here. This is the time of year when U.S. importers are getting stuff geared up to begin getting on ships for building inventories, typically for the holiday season. Not that far away now. We're halfway to May, and it's going to be very hard for retailers, and we have a huge consumer economy here, to plan their ordering, plan their deliveries, and understand exactly what to buy. And there's sort of a joke among some of my friends about wanting to rush out and buy that large television we've all been thinking about for the last 6 months, concerned that the price is going to go way up or they may not be available. So there's some real practical sort of on the street issues here that transcend policy. It's lifestyle and choices.
Okay, Mr. Palit, like I'd spoken, let me come back to you. Let's speak about India specific now. This whole tariff saga now is playing out, and it's likely to keep on going. But the fact of the matter is that as far as India is concerned, how affected or how impacted are we going to be? Because India's export to US is just 2% of our GDP. Now, while I'm not saying that there will not be any impact, but if you look at the macros that are playing out, the dollar index has cooled off. It's likely to remain subdued given what's playing out. The oil has come off very sharply. All of these things augur very well. And of course, with the rate cut that came in yesterday and the fiscal stimulus that, the liquidity stimulus that the RBI has given, it's as far as India is concerned, it looks like a good environment for now. As far as India is concerned, do you see Indian markets to be now recovering on a recovery mode? Have we bottomed out now?
Akita, my take on this is that if we go back to what the Reserve Bank of India governor mentioned yesterday, that there are strong anti-cyclical headwinds to the growth that are coming in from the prospects of merchandise exports, which are really going to be hit in a variety of ways. India's service exports are good and strong. They continue to maintain well. You did mention, this is an important point, that 2% of India's exports are to the United States. But I think the point to be noted over there is that those 2% exports actually figure in one of those rare trade relationships where India doesn't just hold a surplus, but that market happens to be India's largest export market. And it's a critical market for those industries, which are really India's, quote unquote, hot exports, which create jobs, which maintain livelihoods. The point that one needs to accept moving forward from here is that while there are counter-cyclical policies that the agencies might take, particularly the Reserve Bank of India, in terms of a rate cut, encouraging greater disbursement of credit, pickup of loans, what is the current situation of the Indian consumer to respond to this? This is where I think the crux of the matter lies, that the Indian consumer, will he or she really been taking these actions in a very preemptive manner and want to really respond by upping the consumption demand. If that happens, then I think the worries, much of the worries with respect to management of demand will be taken care of. But my concern over here is, Gita, that over the last 4 years, we have seen there is an enormous amount of capex that has come into the economy from the government sector. Unfortunately, the response from the private investors in terms of long term investments coming into the economy, domestic private investors, has not been that much. So it all depends very significantly now upon how much foreign long term private investors are going to look at India with what kind of commitments and what kind of prospects. If we do get to see in this whole space a significant amount of investment relocation to India from whichever parts of the world we might consider, I think the India story will certainly shine brighter than almost all other stories of the world.
Right. So, Mr. Palit, I would assume that perhaps now it's time for foreign fund managers to start reallocating their funds, and in that shuffle, India could be a big beneficiary, especially now that India is in a better position relatively as far as even the tariffs are concerned, and also big beneficiary of the China plus one strategy.
Akita, this is probably where there is a considerable amount of anxiety among the fund managers because what you're saying is absolutely right. That is how the story should go. But the problem is, we don't know what the next step from the United States administration will be. See, if the tariffs are not delivering the kind of results that they were expected to, the next step will be addressing the non tariff trade barriers. And let's not forget that the reciprocal tariffs that have been put out for each country is a combination of what the US considers are actually, quote unquote, barriers to United States prospect. They include tariffs, they include non-tariff. So, for example, if India is now approached upon with a view to correct its exchange rate management policies in order to improve the competitiveness of the American dollar, and if that is also the US response to certain other countries, which it thinks are also contributing to the lower competitiveness of the American dollar, then that's not a good sign for India, and that might get impacted in the trade agreement talks that India is having with the US. If there are serious domestic reforms that have a political connotation that are being asked for, let us say opening up of the government procurement market, or removing tariffs on dairy products, these are steps which will involve pains as far as the Indian adjustment to the Trump trade policy is concerned. So I think this is precisely where the fund managers are still hesitating because they are also not sure that what has been put on a pause is something which is not going to become permanent. There's a story that will begin after the pause, and that's where the uncertainty factor lies.
Right. Before we let you go, gentlemen, one last question to you, Mr. Freeman. Coming to you, once this entire tariff dust settles, which it will in some time, and the final rates come out, the final negotiations happen. How do you see the economic picture in the US pan out? Because there are concerns about the economic growth slowdown. There are concerns of inflation rising. And if that was to happen, then it will have a ripple effect on the rest of the economies, world economies as well, and in India as well.
Well, I think what the doctor's been talking about happening in India and what's going on here and getting worse is simply sentiment. It's confidence and sentiment, and when that happens, negative sentiment, things freeze up, and I think that's one of the reasons that banking leaders like Jamie Dimon and others are coming out and saying that they actually now expect a recession. And this is one of the outcomes, is a recession from this confluence of a lack of confidence, higher prices, probably maybe moderating interest rates, but on a consumer level, it's not going to be that significant unless perhaps you're buying a large capital item like a house or a car. So it takes a while to change sentiments and to get people feeling good about spending money again. I want to comment about this issue of fund managers investing in India. We really have to differentiate between investors' fund flows into the Indian markets versus fund flows from corporations and private equity investors, which have a much longer time horizon. It's important to remember they're quite different. And over the last 20 years of following India, we've seen big shifts in FII, foreign investor flows. And a lot of flows in the markets are based from index funds, not just necessarily institutional investors. And so if money is being pulled out of emerging markets funds broadly or an Asia fund broadly, India's percentage of those indices is getting pulled out. And it's very difficult for the government to set policies to control that.
Right. Okay, with that, we completely timed out, gentlemen. We will have to let you go on that note. But Mr. Freeman and Mr. Palit, thank you so much for taking the time out and joining us in this discussion. And well, with that, it's time for a quick breather. Don't go anywhere. We'll be right back after the break.